Hey guys, what's up? It's Ace coming to you with another video, May 30th, 2020, 5:09 p.m. I wanted to go ahead and do another educational video. I know I've been posting a lot of day trading videos recently, but I wanted to bring to the table a concept that I've recently started utilizing in my trading, which I think this is a great methodology. I've seen a lot of success with it, both on the swing side as well as on the intraday side. And I did want to share this with you guys. So grab a cup of coffee, grab a cocktail, grab some water. This may be a little bit of a longer video, but I promise you, if you watch this through from beginning to end, this might actually really change something in your trading and provide you a tool, if you will, to be able to go ahead and make more money and be more successful. So, with that being said, I have the market phases up. I used this in one of my last videos. Just talking about accumulation and distribution with smart money. Everyone is always looking for the next breakout stock. Okay, they're looking for the runners, the move that'll make them money. And when they see a stock moving on a chart, possibly after a wide ranged candlestick, they hop on the bandwagon and they're hoping to profit from it. Okay, and usually when people hop on, they're hopping on too late. They're hopping on up here, they're hopping on up here. They may catch a couple of points on this move. uh, Gosh, some are even hopping on right here, and they hit this pullback or they hit this choppiness, and they wind up taking a loss. They wind up losing, and why is that? Well, it's easy. It's because the train's already left the station, and you're now chasing. So when you get into these moves that tops up here, or even tops up here. Or gosh, even if you're shorting something and you get in down here after you've seen it falling for a while, guess what? You're these guys. And the train's left the station, and like this guy, you're chasing it. And if you're lucky, maybe you catch a few points on the tail end of the run. More often than not, you're going to lose money, or at best, if you're nimble enough, break even if you're able to get out quickly. So, let's face it, most retail traders, they get in too late. They get in after the move is started or after it's been made. They enter the next day, the market reverses, it starts chopping sideways. I'm sure everybody who is traded that's listening to this has experienced that. Okay. So, bottom line, we're late to the party. We are late to the party and we're getting our asses kicked because of it. So, let me ask this, instead of being late to the party, what if you're able to see the train at the station? And what if you were able to board it right as it's getting set to leave? Do you think that might have the potential to increase your chances of winning on the trade? Absolutely. Absolutely. It's like a rhetorical question. There is a way. And the funny thing is, the way of being able to see this train at the station before it's leaving, it's one of the least talked about methodologies. And that secret, my friends, is something called compression zones. So, with compression zones, we find that most traders get into the trade up here, like I said, at the top of the move, and they literally trade into these compression zones is what they're doing, and they get chopped out of their positions usually for a loss. Guys, once again, if this is you, please stop doing that. Please stop getting in up here and then getting out, in this choppy area. That's not what we want to be doing to make money. Okay. So in this video, what I want to do is teach you how to see these accumulation and distribution zones, aka compression zones. How do you find these on the chart and how do you see them? Okay, because what we want to do is we want to jump in at these points, and this is where we make money. We want to be in the moves that I'm putting the arrows on. These are the moves that we want to be a part of before they start, or right when they start, I should say, right when they start. That's when we want to be in those moves. Okay, we want to be in the thrust moves as they start, and we want to be getting out when smart money is starting to reaccumulate or distribute. All right. So getting back to the compression zones, it's these areas on the chart where we see small-bodied candles, dojis, or possibly even some medium-sized candles, but they're all trading within this tight compression area right here. This is where we're going to find those kind of candle formations, is in these tight compression areas. And this is where the buyers and the sellers, they've agreed on a price point for that security. The beautiful thing about this, guys, is that, and we can profit on this, these equilibrium zones, if you will, they don't last for long. They are temporary. They're temporary. And that's good for us because eventually the buyers are going to take over the stock and they're going to make it run to the upside, or the sellers are going to grab control and they're going to make it fall. But one way or the other, once you find these zones, all you have to do is watch them because definitely movement's going to happen after these zones are done. Okay, and after that equilibrium has passed. So you might be asking me, Ace, how do we know which way they're going to turn so we can hop on that train and we can ride it to profits? Well, there's aspects to technical analysis you can use to determine the possible direction, that are going to come out of these zones. That could be, the previous overall trend. So, like in this, obviously, we're in a bullish trend. We're going up. Okay. So that would be something to consider, obviously, in these compression zones. You'd be looking for upside breaks. Okay. Could you get into a compression zone like this? And could you catch a downside break? Absolutely. Could you make money on it? Sure, especially if you're trading intraday. But, ride the trend. I mean, trend is your friend, especially if the market, the SPY is also going up. Why do you want to focus on taking any kind of a down move, even if it's out of a compression zone? You just want to go ahead and look for these opportunities to ride the market higher out of these compression zones and being on the right side of the market. Okay. So you can use the overall trend. You can use support and resistance levels, which you should be, because each one of these, they're all going to break out a horizontal resistance, as you can see, okay, or break below it. So you want to use your support and resistance levels. Trend lines, definitely. If you have trend lines connecting like here, you want to use those so you can see what's going on there. Look at that. Up, bounce on the trend line. Compression, bounced off the trend line. Compression. So you want to go ahead and use your technical analysis skills. Fibonacci retracements, supply and demand zones, all that stuff is going to come into play, guys, to let you know that when you do find these compression zones, what's the chance of it breaking to the downside or to the upside? You're going to use your technical analysis to answer those questions, okay? Um, but keep in mind, I do want to go ahead and reiterate one thing that my mentor used to always tell me. Trade what you see, not what you think you're going to see coming out of these zones. Okay, always trade what you see. Just because the bias is to the upside, okay, and you have that trend line, does not mean that you cannot get a significant price pullback breaking out of a compression zone. You can, and you can trade it. Okay, so just keep that in mind. Trade what you see, not what you think you're going to see. Let the market tell you what it's doing and then ride the wave. Okay, so with that being said, I want to actually take it back one slide here, and let's just take a quick look at some examples of what a compression zone is and how we track it. So what I like to do is I like to track the compression and wait for a break of it. Okay, I want price action and volume to tell me that there's conviction in the breakup or breakdown and that there's some institutional money that's flowing in. That's going to give the stock the momentum we need to see to watch it rise or watch it fall quickly. And then as soon as we see that break out of the compression zone and we have volume, our technical analysis is telling us this is a good horizontal break, then we want to hop in, we want to ride that wave, okay? Where do we use this trading methodology? The compression zones form best on the daily chart, and they create amazing swing and momentum-based trading opportunities. So let's just take a look at that real quick on this chart. Let's find a couple of these compression zones here, guys. So here's the first zone that pops out to me right here. Here's another zone right in here. Let's see, where else do we see compression zones? Here's one right here. Here is one right here. And where else? Where else? Yeah, actually this would be one. This would be one. This is not a pretty one. It's not clean, but it definitely qualifies. Okay. So look at these compression zone, guys. I mean, here in these compression zones, what do we have? Let's start here. So we have, oh, hold on. There's another compression zone. Let me just highlight this one too for you all. right in there. So let's take a look at these compression zones. I mean, interesting, right? We'll start from left to right. So right here, we had this down move, and then we come right into this area of equilibrium for 3 candles. Keep in mind, compression zones can be 3 candles. They can be 10 candles. They can be 20 candles. They can be 2 candles. There's no right or wrong number of candles that it has to be considered a compression zone. What it has to be is it has to be equilibrium. Okay, write that down, guys. A compression zone is equilibrium. It's where the buyers and sellers are both in agreement on price. And when that happens, price begins to move sideways in very tight consolidated price action patterns like dojis or small bodied candles with wicks on either side. That's compression, that's equilibrium. We want to track those zones for the breakdown or break up. So here's the first one, and what happened? We got to move down, okay? Right into another compression zone, 4 candle compression zone area. What happened? We got a gap out of the compression zone, and look at that run up. Beautiful, beautiful run up. And you could have gotten in a couple of times. You could have gotten in at the initial break of this compression zone right here. You could have also went ahead and got in on the pullback right here, although you would have only gotten maybe 1 or 2 days worth of movement, or maybe 4 or 5 if you were willing to take this little minor pullback here and catch that gap up. Okay. And then what happened? We have another compression zone. What is this? 1, 2, 3, 4, 5, 6, 7, 8, 9 candles. Okay. Now here's the whole thing. Compression zones, this is not holy grail, guys. It's not perfect. You will go ahead and get opportunities where you get breakouts or breakups or breakdowns from compression zones, and they just don't work out. And that's okay. You're going to go ahead and you're going to always use the opposite side of the compression zone as your stop. And you're going to go ahead and use your other technical analysis skills to tell you when you should be getting in or getting out of the trade, okay? So here we had this candle that actually broke out of our compression zone here, and we did get this 2 dojis ridden up to the upside, very weak move, and then immediately we got this literally, I should say, it moved up into another compression zone here. So this would be a tough one, you know, because you're in long. Now all of a sudden you're in another compression zone here. I probably would have just exited the trade, maybe for a small profit or even a small loss. I'm okay with that. But I would have gotten out because I would have seen there's more compression taking place right here. I would have boxed this zone, probably gotten out on this doji here. And what I would have done is as soon as I see this red candle breaking that zone, I would have shorted down and made some money there. Okay. So this compression zone, not the best one, not even a good one. But you can always go ahead and like I said, you know, use good money management skills, use good technical analysis skills. You can figure out how to deal with those type of situations. Here's another compression zone. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 candles. And then look at this, a breakout, beautiful breakout right here on this wide green, wide range body candle. We did, interestingly enough, gap down into a doji the next day, but we would have still been in the trade because even though it gapped down into a doji the next day, we're not even halfway into the compression zone area. Okay, your stop is right here. Your stop is at the other end of the compression zone. So even though it gapped, I mean, God, maybe that gapped 20% of the compression zone area, I'd be in the trade all day long. The next day, we get another huge bullish candle. We get a gap up, and now we are off to the races. What a beautiful trade. I mean, this compression zone right here, guys, big time winner, big time winner. Let's look at this compression zone. So we came over here, we dropped down, did some chopping, did this weird little funky kind of like push up, right back down. I mean, real choppy all in here. But we did get a tight compression zone on these 3 candles here, okay? We got that drop, so we would have been in the trade on this candle dropping down. We pushed back up. Once again, look at how far it retraced into the compression zone. Maybe 15%. We're not getting out. Where's our stop? Our stop's at the top of the compression zone. So we're still in the trade, okay? And what happens? The next day, boom, we get a down candle, and then we start gapping, dojing, another gap, and we're tanking, we're falling. So out of all these compression zones, we have 1, 2, 3, 4, 5 compression zones. How many worked out? 4 out of 5. This one worked, this one worked, this one did not work, this one worked, this one worked, this one worked. I'll take those odds any day of the week, guys, when it comes to trading. Any day of the week, okay? By the way, my day trader friends who are in the room, let me chat with you here just for a moment. These compression zones are phenomenal for day trading. Why? Show me a really great swing trade setup, and I'll show you some phenomenal day trades that you'll get along the way. Okay, so we could have broken out of this compression box right here. Tell me that would not have been a great day. Tell me there's not good day trades in this bar right here. Tell me there's not good day trades in this bar. So my whole point is, if you're looking at this on the daily time frame and you're marking these compression zones, you're getting breakouts, you're getting movement. You can easily trade these stocks intraday and be making very good money, knowing which stocks are going to be moving because they're moving on momentum outside of compression zones, either up or down. Same thing right here, guys. I'm going to show this one last example right here, and then we're going to move on. Compression zone. Day traders, could you have made money here, here? Could you made money on this candle here? I bet you could have, to the downside. So, these, even though we're talking about swing trading and utilizing this on the daily chart, it sets up beautiful to be able to know what's moving intraday so you can make those trades and make that money there. My scalpers, same thing to you. You can find enormous amounts of scalping opportunities within the day, the trading day, as the stock prices move intraday out and away from those compression zones. So keep in mind, once again, guys, as my another mentor of mine has always said, look at the market first. Make sure you find stocks that are moving with the market. You can find some of these stocks that are bucking the trend. So, for example, this stock maybe, we're in this compression zone, and when we get this breakout here, you would want to see the SPY and the QQQs moving to the upside during this rally period. Okay, could this stock be rallying while the market's tanking? Absolutely. But 75% of all stocks move in tandem with the overall market. So just keep that in mind when you're looking at these compression zones and you're looking at breakouts and breakdowns. Look at where the market's at too, and just make sure you're always putting the market first. If you can, look at the sectors as well. That helps too. If you happen to be in one of the strongest sectors in a strong market, the chances of you catching a move like this are much higher. Or if you're in a weak a sector, you have a weak stock in a very weak sector in a weak market, getting moves like this also becomes a little bit easier. Well, easier is probably not the right word, but more probable is what I'm trying to say, because you have the market wind behind your back. Okay. Um, so why do these compressions happen? Let's just talk about that real quick. I think that's important to know. These compressions happen because smart money in these areas right here, and I'm going to just draw a couple more of these zones here one more time. Smart money is, even if it's just for two candle days, 3 candle days, 10 candle days, whatever it might be, when you get into these compression zones, smart money's quietly accumulating or distributing their shares here. That's what's happening. Okay, right here. We'll use this as an example. They are accumulating or distributing their shares. They're most likely buying or selling through dark pools. They're doing it in controlled blocks, hence why we have small candles, dojis or small bodied candles. They're doing this because they don't want to disturb the price of the stock. They want the price of the stock going sideways, okay? And they don't want to alert us retail traders to their activity. This is going to allow them to buy or sell at this preferred price point to their heart's content. Remember, they're buying tons of stock. They're buying tons of shares. If they don't buy it in a controlled way through dark pools, they'll get moves. They'll get the move quickly, and we'll see it, and we'll all jump on board, and it becomes a self-fulfilling prophecy, and the stock's going to skyrocket. And they're not going to get their full position. They're not going to get their full position, and that's what they want to do. So in order to make sure they lock in their full position, they're quietly buying and selling through dark pools, and they're making sure to do it in a way that keeps the stock moving sideways until they're ready. And once they have went ahead and they've made all they've built their whole position and they're ready to make money, then at that point, high frequency traders are taking over, the algos are kicking in, and the momentum is what's going to push that price up or down. Okay. Where do these stocks take place? They often precede a decisive breakup or breakdown. They're either going to run out the gate or they're going to form a gap. Pure and simple. Okay. So, here's a decisive rundown. I did not mark this one, but let's mark this one here real quick. And here, okay, so here's a decisive run up. Here's a gap. Here's a gap up, and here's a run up. Okay. On this one is, I'm not going to talk about that one. That's an ugly one. On this one here, was there a gap? No, but there was definitely a run up. On this one here, was there a gap? Well, not till this point here, but there was definitely a run down. And even though we got that retracement, we still got follow through, and then we got our gaps, and then we continued to go down with even more gaps. So um, after they run, the stock usually will return to a sideways pattern. And then smart money, once again, through the dark pools, are either going to start buying or they're going to start selling again. Okay. And we see that here. Accumulation, up step, accumulation, up step, accumulation, up step. Okay. And so that's exactly what they're doing. You get that move up and then it resumes right back into this pattern again of sideways action where they're accumulating or distributing. Move up, right back into this side step again. So it's very interesting when you really look at this on a chart. You can see where smart money is accumulating and distributing. Okay? And they're going to rinse and repeat this process over and over again. And it's how they move in and out of their positions without disturbing price action. They only want to disturb price action and get these moves when they're ready for them. Excuse me. Until then, they want to keep everything very controlled because their position size is so large. The only way they're going to get their full position is before the stock moves is by making sure they keep it very, very hush, hush, quiet, quiet going through the dark pools. Okay. But the idea for us, we can ride the coattails and make money, guys. We can see what they're doing, can ride the coattails, we can make money. These compression zones are just absolutely amazing. So with that being said, let's take a look at some real examples here before the video gets crazy long. We're already 21 minutes. Here's Qualcomm. Let's just step through Qualcomm real quick. So we come over here, compression zone. Look at this, 1, 2, 3, 4 candles, up move. Let me get my drawing tools. So 1, 2, 3, 4, and we go into an up move. Here's a compression zone, multi-day compression zone, goes into earnings. We did get this gap down. This is a little nasty because of the earnings. We gapped and then we came up, then we retraced. But you did get a little bit of move down here, on these two red candles. Let's see, where's the next compression zone? Here's a 3-candle compression zone right here, a break over compression, a ride up. If you were planning to hold this for a little while longer, you could have seen this pullback no problem because you would still have profit. And then look at this green candle launches up above this one here. So we break out over horizontal resistance. We gap right up into what could be kind of considered, I guess, like a little mini compression zone right here. I didn't even recognize that one. Look at that. And then from there, what do? We gap up again. And keep in mind, this would have been a total earnings play. I think you would have been able to get out right in this compression zone and make really good money, especially from the breakout of this compression zone here. You would have gotten that entire move up. But I don't know how many people want to hold through earnings. I personally don't hold through earnings. If you like to hold through earnings, look at what you could have gotten. This entire gap area all the way up, okay? Very, very cool stuff, guys. Let's go ahead and just see what else we have here. Look at this compression area. And once again, did this one work out? Nope. This was what I would call a compression zone that didn't work out because we had this compression gapped down. We probably would have went short here, maybe thinking, well, if you're an aggressive trader, you might have shorted it. If you're conservative, you might have waited. It doesn't look like there was a whole lot of price action that day. It's a doji, but if you're aggressive, maybe you got in. And if you got in, you got a bear gap trap. This thing gapped down. Maybe if you were nimble enough, you could have taken some profits here, but then it started moving back up. And what did it do? It moved right back up into another compression zone right here. So we got 1, 2, 3, 4, 5, 6 days of compression. We got this outside compression candle moving to the upside, but then we got a gap up. This would have been a pure day trade play, but you could have easily have taken that gap up in the morning, seen that it gapped over a compression area, and rode that all day long to the upside. This is definitely not a swing opportunity by any means, but you could have definitely day traded that and made some money, scalped it and made some money. Absolutely. So that's Qualcomm with a couple of examples. Let's take a look real quick at PayPal. I think PayPal is going to show us how we can use compression zones to really ride a very almost like what I call a parabolic stock, a stock that's literally just going up like crazy. Here's that compression zone right in here, 1, 2, 3, 4, 5 days. We had this green candle here break over the compression zone, and then look at this, we're off to the races. We could have taken it right up to this support area of 121, closed it out, good money. We would have gotten in at about 111. We would have gotten out at 121. 1, 2, 3, 4, 5, 6 days worth of trading, 6 days worth of holding this position. If you're trading front monthly options at the money, man, this would have been sweet. You would have been made some good money there. Um, let's take a look at Regeneron. I think Regeneron had some pretty cool examples, if I remember correctly, of the compression zones. Yeah, look at this, guys. Man, this is gorgeous. Remember that stair stepping? Remember I was showing you that? The stair stepping? Where is it? Okay, here it is. Compression zone, step up. Compression zone, step up. Compression zone, step up. Look at this. Here's a real life example of it. Compression zone, step up. Compression zone, retrace, but step up. Compression zone, step up. So, I mean, it works. And then as we continue, look at this. Another compression zone area over here. Now, this is interesting. Okay, because real quick before I discuss this, let me go back here. Compression zone into earnings. Gap up after earnings. You could even consider these two candles really a small compression zone, push up through resistance, and then look at this. Another compression zone, which I didn't even highlight right in here, and then another step up. Compression zone, long compression zone, which did break out up and over, retraced, barely retraced into the compression zone, broke up again, and you could have easily have taken some profit. So you would have gotten in here, could have gotten out up here. What is that? Getting in at 377, getting out maybe on this candle somewhere around the 390-ish area. Hey, that's not bad. $20 move up, you know. I definitely would have been out. I would not have seen any of this. Look at this compression zone right here. And then look at that breakout and up. Gaps up over resistance, pulls back into resistance, bounces on resistance, pushes back up. Obviously, that's not compression zone. That's just a standard pullback. But the compression zones are showing you the trend is obviously up. I mean, look at the MACD for God's sake. The lines are highly extended out. You know, you got a momentum printing. This look at the extension on those lines, guys. I mean, holy crap! Look at all this area in here. I would have definitely have been tracking this, and even if I would have gotten out on this pullback, I would have gotten in at least at this point here on this break above on this candle. I would have gotten back in on this candle. This would have been some nice day trading up in here. But going back over here, look at this multi-candle compression zone. Look at this. It literally drops, but it drops into a doji and into another compression zone. So one compression zone into the other, literally back to back. Very interesting how these things form. But look at this. If you would have seen this compression, watch the drop. Maybe you were disciplined. You didn't just jump right in. Okay. Let's say even if you did, you see this doji here. You're starting to go ahead and see the MACD curling up. You probably would have gotten out. You're definitely bouncing on support. So, I mean, if you would have taken this to the downside, you could have made some money if you were nimble enough to get in when the prices or get out when the price is down here. But look at the next day. A breakout above this compression area. And if you were still needed, I mean, look at that wide body candle. If you still needed more conviction, you could have waited and you could have day traded the next day to the upside also. So, I mean, just this stuff is so cool, man. I'm telling you guys, this is, to me, ever since I started using these zones, it has made such a huge difference on my trading. Once again, some more compression zones. Look at this long compression zone area, and then boom, we flushed right into earnings. After earnings bounced back up into a compression zone, boom, broke out, gapped up, moved up down into this compression zone. This one did not work out. This was a breakdown. You could have taken it here, but you would have immediately the next day gotten a push up. And if you were disciplined enough, you would have gotten out probably for a small loss. Fell right back into this compression zone here. And then look at this breakout and break up. So do these work all the time? No, absolutely not. Nothing's perfect in the market. Look at this compression zone, guys. Wow, look at that. Right into a gap up. Small, very shallow pullback. Didn't retrace maybe 50% of the body of the candle. And then look at that. Just ran for like 4 or 5 days afterwards. And then this whole area, no compression zones at all. So you can actually go quite a long time with no compression zones. Look at this stock ran from February all the way to present day, and there's no compression zones in here at all. So it's not like you're going to find them on every stock chart all the time. You have to look for them because right here we haven't had a compression zone on NTES since back in January. Okay. Um, Anyways, guys, let's see other takeaways. Bollinger Bands. Let me just go back here real quick to Qualcomm. And I know this video is long, but I did say in the beginning it was going to be a little bit of a longer video. But like I said, this trading methodology is so amazing. I just don't want to cut you guys short on the knowledge I'm trying to impart. So let's see. Bollinger Bands can be pretty good for this. Bollinger Bands, they can show actually where the squeeze is happening, where zones are forming on the chart. When the bands are expanding or contracting, you can analyze really where that volatility is coming into play. So as the bands contract, you can sometimes see these squeeze zones. I like the Bollinger Bands, but I don't necessarily need them for this. I actually prefer having a naked chart up, but let me just put on the Bollinger Bands here real quick. And you can see when they're squeezing together how you do get some of these compression areas to form. Like right here, look at this. See how they're squeezing together? And then there's that compression area right there. Me personally, like I said, I prefer not to use the Bollinger Bands. Like here's a compression area up here, but the compression area happened after a run up right before a drop down. Bollinger Bands did not catch that. That was they had not been able to compress yet. You will find these type of opportunities with Bollinger Bands where they are compressing. Probably right in here is also a squeeze too. But once again, I prefer to utilize this particular strategy without Bollinger Bands. I prefer to literally do it with no overlay and just utilize the actual price bars to show me and tell me where those opportunities are at. Okay. Um, what else before I go? Oh, that's another thing. Once again, these really can keep you out of unfavorable market conditions quite a bit. The market does, I think about 50 or 60% of the time, the market's always in a range bound area. So, if you're literally watching these areas, these compression areas, waiting for movements out of them, it'll generally help to keep you out of bad trades where you're trading up and into a compression area and getting chopped around. Because instead of trading on the actual moves as they're taking place and trading like on here, like maybe you get in here on this little pullback, or maybe on this bar, you get in on the second bar thinking it's going to keep running, but then you hit this compression area and a lot of people are getting chopped up and losing there. Instead, you're going to be watching these compression areas so that way you can be on the side of the move that goes up or goes down, like this one. You could have been on the side of the move that allowed you to go down, or this one that would allow you to go up with the actual market. So, or like right here on this small compression area, and you could have gotten those two bars up. So just keep that in mind. I think that's about it for now, guys. The video is 32 minutes. I had a couple other things I was going to chat about in regards to this, but I think I've given you the meat and potatoes of it. Hopefully you find this trading strategy to be really interesting. If you have any questions, post them below. I'll be happy to answer some more questions on this trading strategy. One of the things I think I'm going to do is probably do another video on this, but I'm going to use on demand on Thinkorswim. I'm going to go and just choose a random day within the past couple of years. And we're going to go ahead and actively in real time look for compressions and maybe even swing trade them and see how those would have worked out. Okay, so that can give you a little bit more substance on this particular trading methodology. If you got any questions, once again, leave them below. Hopefully you enjoyed the video. Please do give it a like and please subscribe to my channel. I will have more videos coming out educating traders on different types and styles of trading methodologies. I'm going to be doing some more indicator videos coming up. I'll probably post some more day trades with some day trades or swing trades I'm doing. Anyways, guys, enjoy the weekend. I hope you all are having yourself a great day, and I'll talk to you all soon, okay? Take care.